Hello, my name is Tyler Dean, and I'm going to be talking about derivatives in the stock market. This video is for my honors addendum in Calculus 1 of Fall 2020. The stock market. Today, it can be anything, really. Day trade, monthly trade, year trade, lifetime investments. There's so many things going on in the stock market every day that it's basically impossible to keep up unless you're paying strict attention and are basically a day trader, or you just do your nightly watch of the NASDAQ. The stock market always seems to be predictable because prices are changing every minute of every day. Stocks can skyrocket or they can crash in minutes, days, or weeks. It's kind of hard to predict because there's so many variables, but we can get a pretty good idea if we look at everything separate and how those can combine to make a flowing equation. Now, looking from the outside of it without looking any deeper, it just looks like a bunch of numbers going up and down, positives, negatives. There's just a lot going on, especially if you're in the brokerage room. So how are we able to calculate all these numbers to help give us the competitive edge in the market, or just to invest more smartly as a company or as a personal owner, or just in personal stock ownership? The answer to help with getting a grip on these random changes of numbers in the stock market is just by using derivatives. We can use derivatives for a lot of things in the stock market, which can help us make smarter, safer investments and have potentially bigger returns because derivatives can help us predict future outcomes. Now we're going to take some time to understand the stock market and how to understand stock movements by using derivatives. We're going to start out with what is an economic derivative. A derivative is a financial security with a value that is reliant upon or derived from an underlying asset or group of assets. Stocks, bonds, commodities, currencies, interest rates, and market indices can all be variables. A stock derivative is a financial instrument that contains a value based on the expected future movement in prices of the asset to which it represents or is linked to. The assets in a stock derivative are stocks. However, a derivative in general can take the form of any financial instrument, included currencies, commodities, and bonds. To go further into this, a derivative is a contract that derives its value from the performance of an underlying entity, such as the things on screen. This underlying entity or entities can be an asset, index, or interest rate, and is often simply called the underlying. Derivatives can also be used for a number of purposes, including insuring against price movements, also known as hedging, increasing exposure to price movements for speculation, or getting access to otherwise hard to trade assets or markets. Some of the more common derivatives included forwards, futures, options, swaps, and variations of these, such as synthetic, collateralized debt obligations, and credit default swaps. Most derivatives are traded over the counter or off exchange, or even just on an exchange. An example of this would be the Chicago Mercantile Exchange. Derivatives are one of the three main categories of financial instruments that are used in the stock market. The other two main instruments are the equity and debt. Derivatives market, you have credit, freight, futures, hybrid, inflation, and property. Just another definition of the derivative, a little more. Derivatives are securities with prices that are dependent on or derived from one or more separate underlying assets, such as options or future contracts. The need for derivatives, like I mentioned earlier in the video, is that the derivatives market performs a number of economic functions They help in transferring and calculating risk, discovery of future as well as current prices, which can help us predict future prices for future investment, catalyzing entrepreneurial activity, or increasing saving and investments in the long run. Just some flow charts. Price discovery and price risk management are huge general ideas of all the variables you see underneath them. And securities are also huge parts of derivatives in the stock market. I'd like to thank you for watching my video, and I hope you all have a good day.